So, what happens when a company that makes life saving tech has some, well, pretty serious red flags on its own books? That's exactly the puzzle we're looking at today with Kernex Microsystems. They're a huge player in railway safety, but their amazing potential seems to be on a collision course with some really worrying financial issues. Let's break it down. You know, it's almost like you're looking at two different companies here. On one side, you've got this incredible tech success story, brilliant engineering, massive nation building contracts. It's the kind of stuff that gets investors really excited. But then you look at the other side, and the financials, the internal controls, they're just not adding up. It's this big contradiction, and we're going to dig into both sides of it.
All right, so let's start with the good stuff, the really exciting part, right? The technology. This is the side of the story that has everyone buzzing, and it all comes down to a system called Kavach.
So, what is Kavach exactly? Well, let me tell you, it's not just some minor software update. No, this is the big one. It's the core technology that's supposed to completely modernize safety across the entire Indian railways. And its main job, its whole reason for being, to stop train collisions, plain and simple. Yeah, Kavach 4.0 is a huge leap forward. Think about it. It's designed to work with all the different complex signal systems out there. I mean, on a network as massive and complicated as India's, that is no small feat. And this isn't just some blueprint or a cool idea on a whiteboard. Nope, the development is done, and right now it's going through some seriously tough real-world testing. And all that amazing tech, it is paying off big time. We're talking about the kind of contracts that can completely change a company's future. Get this, 536 crore rupees. And that's not over a dozen projects. That's the value of just two massive contracts that a Kernex-led consortium managed to win. For a company their size, that is absolutely game-changing. We're talking transformational stuff here. And just to give you a sense of the scale we're talking about, those contracts cover installing their safety systems over 1,500 kilometers of track. That is a massive, massive infrastructure project. And it's not some future plan. Work is already underway. Okay, so with contracts that huge, you'd be forgiven for thinking their finances must look incredible, right? Record profits, happy shareholders, the whole deal. Well, this is where the story takes a really sharp, unexpected turn. Because when you look at the numbers, things get weird. And hey, at first glance, things look awesome. I mean, look at this. Revenue from operations just exploded, from around 200 lakhs to over 1,900 lakhs in just a year. That's almost a 10x increase. You see that and you're thinking, wow, the profits must be through the roof. Yeah, about those profits? That's the million-dollar question, isn't it? Because when you scroll down to the bottom line, the profit margin, the picture doesn't just get dark, it completely falls apart. Negative 105.74%. Just let that sink in for a second. What that means is for every single rupee of revenue they brought in, they actually lost more than a rupee. So all that incredible 10x growth in revenue, it was completely swallowed up and then some by these absolutely staggering losses.
Okay, so what's going on here? Well, the most likely explanation, the one management would probably give you, is that it all ties back to those giant contracts. To roll out systems over 1,500 kilometers, you have to spend a ton of money up front. On equipment, on people, on everything. So you could see this as a strategic gamble, right? Take a huge hit now, swallow some big short-term losses to secure the market and reap the rewards later on.
But this is where things get even more complicated. If you look at their track record with risk, it's a mixed bag. On one hand, you see this really smart, prudent move. They had a project in Sri Lanka, they saw it wasn't working, and they got out through dialogue without losing a single rupee. Brilliant. But then you look at their US subsidiary, AGI, and it was a total disaster. It completely collapsed, forcing them to take a massive, painful write-off. And that whole process of admitting the money's gone, well, there's a fancy accounting term for it, impairment. It's basically a rule that says, hey, you can't pretend this asset is still worth what you paid for it. You have to officially reduce its value on your books. And as you can imagine, that's a huge hit to the balance sheet. And the number they had to impair? A whopping 12,760 lakh rupees, or nearly 128 crore. Just gone. Poof. Wiped clean off the books. But here's the kicker. It turns out that wasn't even the whole story. And this, folks, is where things get really serious. Because it's not just us asking questions anymore. The company's very own independent auditors, the people hired to check their work, they stepped in and raised a major red flag about the financials. They gave the company what's called a qualified opinion. Now, I know qualified sounds kind of good, right? Like you passed. But in the world of accounting, it is the exact opposite. It's a huge red flag. It's the auditor basically saying, listen, most of this looks okay, except for this one really important part where we think you guys got it wrong and didn't follow the rules. And here's exactly what they were fighting about. Management said the write-off for that failed subsidiary should be about 128 crore. But the auditors came back and said, no, our math says the real loss is over 141 crore. That's a difference of more than 14 crore rupees. Think about that. Their own auditors are saying they understated their loss for the year by 14 crore. But honestly, that disagreement over the number, as bad as it is, points to an even deeper, more fundamental problem. See, it wasn't just about what they were counting, it was about how they were counting it. Their internal systems, it turns out, have a major weakness. So the auditors found that the company didn't have a proper digital edit log or audit trail switched on. Now that's just the basic electronic record of who changed what number and when they changed it. And we're not talking about some minor spreadsheet here. This was missing for critical areas like the payroll register, fixed assets, and this is the one that really gets me, the system for buying raw materials. If you literally can't track who's changing the numbers in your core systems, you have a massive, massive risk. So where does all this leave us? I mean, when you take a step back and look at the whole picture, it's just so contradictory. You have this amazing story on the outside, the future of rail safety, massive growth. But then you look on the inside and the financial foundations, well, they look like they're starting to crack. And that really brings us to the central irony of this whole thing, doesn't it? Here you have a company whose entire reason for being is to build safety and integrity into complex systems, systems where a single mistake can be catastrophic. And yet, their own financial systems have been flagged by auditors for lacking exactly that, integrity. And so we're left with this one big question. Where does the real story of Kernex Microsystems actually lie? Is it in those huge, game-changing contracts and the promise of a safer future? Or is it hidden away in the fine print of a pretty damning audit report? It's really that classic battle between incredible promise and concerning performance. What do you think?